Everyone, welcome to our first quarterly investor call of 2024, and thank you for joining us today. The call is being recorded and will be available for replay by visiting our website, clicking the resources tab, and then clicking the quarterly investor call. So let me advance here. Before we get started, I have to remind you that the purpose of today's call is educational and that the material presented is all publicly available information from sources we believe to be reliable. The information in this presentation may change at any time and without notice. Furthermore, the presentation is not intended to provide any specific recommendations to your individual personal circumstances. If you do want to take action on any of this information, you should consult with your accountant, attorney, or financial advisor based on your own individual needs. Okay. We still have a few people joining here, so I'm just gonna let these people into the meeting and we will get started. So good afternoon, everyone, and thank you to those of you who are attending the live presentation. And for those of you tuning into the replay, thank you for your time and attention too. We are changing up the format for the quarterly call in 2024, and this was after we successfully launched our in-person investor forum in October 2023. At that live event, we had about 75 clients in attendance, and the format was an open question and answer with me facilitating questions that were prepared ahead of the presentation and then involving audience members at the end. And the feedback that we got from those live attendees and those of you who listened to that recording was that this was a far more engaging and interesting format. So we're adopting the Q&A approach instead of having prepared remarks and a scripted presentation. So I have some initial questions for Peter and Dominick today. I'll ask them those questions and they'll provide their answers. And during the call, if you would like, you can use the Q&A chat feature to submit your own questions. We will read those out loud at the end of the call in the order that they're received and respond to those questions. So I'll jump into our prepared questions. Peter and Dominick, you both recently attended the Consumer Electronics Show in Las Vegas. Tell us about your trip and highlight some of the things you learned about our investments and any of the new technologies you saw while you were there.
Sure. Yeah, I'll start it off. It was incredible, the advancements in technology we've seen, and honestly, some of the stuff seems futuristic. So you can imagine, based on the talks that we've had in the past, what dominated the conversations, and that was artificial intelligence and how it's going to improve basically everyday life, whether that's at companies making them more efficient. Or just at home, virtual reality, augmented reality. So I'll just highlight some of the cool exhibits that at least Pete and I got to see. The first one was from a car company, and it was incredible. It was an infotainment system, which is basically just the interior of the car. And the way vehicles are going towards more autonomous driving is cars are now no longer going to be just like a form of driving, but it's going to be more like a meeting place. So one of the things that was on display was, instead of you just getting in the car and driving, basically the front two seats would turn towards the back seats, and you could have more of like a meeting than just your typical front seat and back seat passengers. Another thing we saw was, I believe John Deere gave a a presentation, and they showed what an autonomous and an electric excavator would look like and how that is going to be in operations in the future. And for us, what that could possibly mean is if you think about how commodities are produced, maybe copper, gold, a lot of the costs are on the manpower and also the energy side. If you can eliminate or significantly reduce those costs, that'll flow basically directly to the bottom line. And then the last thing I'll say is we were able to meet with a lot of startups or very young companies that were there looking to get funding. One of the ones that I thought was most interesting was basically a robotics company that instead of having employees stock shelved at convenience stores or grocery stores, they're making robots that are going to do it for them. So in the future, you can imagine instead of having overnight stockers stocking the shelves, you're just gonna have robots stocking the shelves. And again, with the labor shortage that a lot of stores are seeing, this should go a long way for them. So those were the main highlights from mine, Pete.
Sure. The major themes that I saw at the event was artificial intelligence, and of course, we've been bombarded with that ever since Chat GPT came out in November of 22. And so that was a major theme from the show. And also, as we expected, also the automobile is literally no longer an automobile. It's a computer on wheels. And many demonstrations of companies that have so many different technologies that are going into an automobile. So it was wide and quite diverse from that standpoint. Somewhat overwhelming is literally the layout of the show was the convention centers are the main center, the north, south, east, and west sections and all connected. They're just massive and just a little overwhelming. It's amazing to see some of our companies that were there, and the Qualcomm's chips being used in augmented reality things, and in such a strong position there. And we also had the chance to see the CEO of Qualcomm speak and re-energize us and give us back some additional thoughts of what we already knew about the company. They're in very, very strong shape. The world is going wireless. If you want to go wireless, you have to go through the Qualcomm toll booth. They are the dominant company in 5G and cell phones, but the wireless is going to be so much more than cell phones. And also, in seeing some of the computer gaming things, almost all of the ones that we saw were using the NVIDIA GPUs. I had never seen a GPU other than on the computer before, and it's so much larger than a CPU, and the progress that's been made in that area. And then on Monday of that week, NVIDIA did a presentation where they've just come out with several new, much more powerful GPU chips to continue to improve the gaming experience for gamers. So just a wonderful opportunity to see things from a very different perspective. Justin?
Yeah, thank you, Peter. So next question, while you were in Las Vegas, you got a chance to visit the Sphere, which is a holding in our portfolio. Tell us about the Sphere experience and a little bit about what you think about the company.
Sure. The pictures and the videos that you see online, I think do no justice to the actual technology and visuals that are on display at the space. We got to see the postcards from Earth, which is Sphere's internally developed movie, and I'll just say it was generally not the type of movie I would go and see it. But the experience, the visual displays, the haptics, the wind, the sound, it all was so much better and different than anything you could experience anywhere else. We got there a little early, and in general, they get you there an hour early. The movie is then an hour. So you're there for about 2 hours, which I would say from our standpoint, as owning the business, we would like people there as early as possible, buying drinks, souvenirs, things like that. So, and in addition to the movie, they have 6 robots that use AI that are on display. You can ask it questions, and it's just a fun, interactive experience. So I would say coming away from that, there is nothing else like it in the world, and I would expect more of these venues opened up in the future.
Pete, any comments on the Sphere experience?
Sure. There's been, I've never had a experience quite like that. Anything close to the size of this. The theater fits 17,500 people, and literally the entire Sphere is the screen, both the roof of this as well as the screen in the front. And so you almost feel like you're in a spaceship as part of this adventure. It's been a very short-term investment. It's the former Madison Square Garden, and they're going through a evolution. And revenues only began for the Sphere in late September with the U2 concert series beginning, and the postcards from Earth is beginning as well. So we're in the very early phases. It's unclear, but we've listened to a number of other investors and developed our own thesis on the investment, and we'll continue to get clarity on this as we move forward throughout this year. But hopefully the Sphere concept can be franchised throughout other parts of the world as well, and have it as a meaningful revenue stream as well, because technologically there's really nothing like this, and so it's going to be a fascinating experience to continue to see this as it evolves over the next several years.
Great. Well, it sounds like Las Vegas was a good trip for the research team. I want to move the conversation into some of our new opportunities. Maybe you guys can talk about where you're finding value today, and what are some of the data points that you're considering in the current environment. So Dom, I'll start with you, and then Peter, you can chime in next.
Sounds good. So I think we've discussed this a little in the past, but small cap stocks are historically becoming very cheap relative to the large cap counterpart. If you read anything in CNBC, Wall Street Journal, typically all they're talking about are the stocks known as the Magnificent Seven. So your NVIDIAs, Apple, Microsoft, Tesla, and so on. And so very few investors are actually focusing on these smaller names. And small can be, 5 billion, 1 billion, couple hundred million. But typically the reason investors don't gravitate towards smaller names is, some investment mandates force them to invest only in large cap or only in mid cap companies. So they actually can't go towards these smaller names, or just the amount of liquidity that are in these smaller names. They're just unable to build a position that would be anything meaningful. So, when we have the opportunity to build a decent sized position in smaller names, it's advantageous for us to look there. And on the chart, it shows the relative valuation of small caps versus large caps over time. And as you can see in the chart, the green line shows the average over the past, call it 20 or so years. And on average, small caps typically trade at a slight premium to large caps. So the average is right around 1.05, which just means over the past 20 years or so, small caps might have traded at 21 times earnings, large caps traded at 20 times earnings. And if you divide the two, you get 1.05. So just historically, small caps have traded around a 5% premium to large caps. And the chart today shows that not only are they trading at a discount to large caps, they're actually trading at around a 40% discount. So we've gone from a slight premium to a massive discount. And when we see this sort of dislocation, it's something that we need to deeply explore. We not only have to, just assume small caps are probably cheap, but we also have to, note if there's any reason why this discrepancy might have happened. So right now, small caps are our dominant focus on where we're finding new opportunities.
Yeah, Dominick, we had just switched charts on the screen. Why don't you talk a little bit about what we're seeing here?
Yeah, so building on that last point, one of the reasons there might be such a big disconnect is just due to the way companies' debt profiles are structured. And this chart shows the composition of large cap stocks versus small cap stocks. And as you can see, the floating rate nature of small caps is much more pronounced than large caps. So large cap stocks in general have 6% of their debt floating. And the way floating debt works is it's basically a spread off of some benchmark. And that benchmark might either be SOFR, it might be the 10-year treasury. So it might be a 3% spread over the 10-year treasury. And so for a floating rate bond, that was based off of a 2% treasury rate with a 3% spread, your all-in interest rate is 5%. Now that the treasury has gone, the 10-year has gone from, call it 2.5% to 4.5%, 5%, that interest rate small caps are paying has now gone from 5% to 8%. And that for some small cap companies can be pretty hurtful to the bottom line. So look at the second and third lines or second and third charts. In addition to having a fixed debt structure for large caps, they have a very long maturity profile, notated by the 49% of debt due after 2030. So a lot of large cap companies not only have debt maturing, 6+ years away, they also locked in this debt at much lower rates. So if there was one reason why we would point to maybe small caps deserve to trade at a little less of a premium or maybe a slight discount compared to the historical premium, it's possibly because of the debt maturity profile and the debt structure of small cap stocks. With that said, going from a 5% premium to a 40% discount is unlikely to be the full rationale as to why small caps are this cheap today.
Great. Why don't we talk a little bit about some of the other areas where you're finding value? Peter, did you want to add anything to what Dominick had said?
Sure, I would like to. Dominick and I had an opportunity to attend the Berkshire Hathaway annual meeting in early May in Omaha, Nebraska. And prior to that, we attended the Guru Focus meeting. And that's a group of value investors that are looking to, similar to us, to find things that are trading at substantial discounts to their value. And you very often get a feel for how other folks are doing things. This year, we noticed that very, very few small cap stocks were presented. And most of the companies that presented were companies that are what we would label as operating on all cylinders. Companies with consistently high, very high price earnings, dominant market shares, but they also came with highly premium prices. Instead of we have several companies that were trading at 3 and 4 and 5 times profits and times cash flow. Many of the companies we saw, like Brown-Forman and others, were trading, and Microsoft, were trading at close to 40 times profits. So the investors out there who are considered value investors have turned to being large cap growth investors, and so the interest, where our interest lies, it does not appear to be very crowded. It appears that the crowd is actually our peers have moved in an opposite direction, and so we believe that's going to be very beneficial for us in the long run as well.
Great. Maybe we could apply this information to a couple of the companies I know we've talked about internally, but just on our portfolio side, could you talk to a couple companies that fit this small cap bill and maybe just narrow it down to these two that we have on the screen here.
Sure. Well, why don't I start here with Fannie Mae? Fannie Mae actually is one of the world's largest and most profitable companies. The reason that it's a small cap company is because the price of the stock and the fact that they're under conservatorship by the federal government. It's trading at a fraction of what we believe it to be worth. They're a very, very profitable company. We're starting to see some favorable court rulings. Most recently was the Berkeley Insurance Company versus the Federal Finance Agency. And they said that the Federal Home Loan Finance Agency had acted arbitrarily and unreasonable in its role as conservatorship when they put the company into the net worth sweep in 2012. And it was a win for Berkeley Insurance Company. And we believe that's ultimately going to lead to the privatization of the business. And you've most recently seeing a movement in the price of both Fannie Mae common stock as well as the preferred stock. We continue to believe it has tremendous upside potential. So, Dominick, do you have anything to add and maybe talk about Greenfirst as well?
No, I don't have anything to add on Fannie Mae. I'll just chime in on Greenfirst. Greenfirst talked about it a couple of times, just a small Canadian lumber producer, couple hundred $1 million market cap. I'll tell you, I think there's maybe 5 people I follow that talk about this company, and that's only because I'm in basically their circle. Outside of this minor circle, nobody is talking about this company. And liquidity is an issue with this name. You can't build a big position. They've had some headwinds on the lumber pricing side, but in general, they have several assets that we expect to get monetized over the next, call it, year or so. And then ultimately the plan is for them to sell the business, could be 2025, 2026. And that's typically how we'll plan to exit this position. So 2023 had some headwinds on the lumber pricing side, but thus far in 2024, we believe that they're well positioned to see growth in the future.
Great. Hey, we just got a question, and I thought maybe we'll just pause because it's applying directly to this conversation about small caps. The question is, could the relative low valuation of small caps be due in part to the distortion from the massively valued 7 tech stocks that you cited? The Magnificent Seven?
Yeah. So I'll start. I'm going to say yes and no. They're not that, I'm going to say not that expensive in that they're not outside of NVIDIA, which is trading at a very high valuation. Apple, Microsoft, Google, they are not trading at 100 to 200 times earnings. They're, I think last I checked, somewhere between 30 and 40 times earnings. And if you look within the S&P, I would say a lot of high quality companies are trading around that valuation, whether it's Ferrari, S&P Global, probably ServiceNow. A lot of tech companies after the rally in 2023, they are all trading at relatively high valuations. So I think there's probably a couple that maybe skew it to the higher side, but I think there's I think just the overall market, or maybe the top heaviness of the market, is probably just more on the expensive side relative to history.
Yeah, I'll chime in as well. I've been doing some research for the quarterly newsletter that we're writing, and the Magnificent Seven, the technology stocks, they carry, as Dom said, maybe price to earnings ratios of about 35 to 40 as a group. And relative to the last, bubble, so to speak, that we had in tech stocks, which was the early 2000s, that figure is much lower. We saw the top 10 tech companies in 1999 with price to earnings of about 90. So it's been it's been an outsized growth for these companies, but they still, relative to their earnings, they do not look exceedingly expensive, I would say. Peter, anything to add on your end?
It seems to me that the reason for the large companies to continue to have the higher prices, it's that they've performed really well for the past 10 years, and it's a matter of just believing that that's going to continue forever. And so it's just, you get the feeling that that whatever price you pay for Microsoft or Brown-Forman, that it's, even though it's 30 or 40 times earnings, it's going to continue to pay off as it has for the previous 10 or 15 years. So I think that's one of the factors that's contributing towards it.
Thanks. I put another chart up on the screen, and this is to move away from small caps and maybe just talk a little bit about the opportunities that we're seeing in income producing or dividend stocks. Dom, I have this chart up here that shows historical valuations of like the overall market as measured by the S&P 500, and then the dividend aristocrat, or your blue chip dividend paying stocks, and their differences in price to earnings. So maybe talk about that a little bit.
Yeah. So just note on the dividend aristocrat, these are companies that have paid and raised their dividends for, I believe it's 25 consecutive years. These are your Sherwin-Williams, Targets, 3Ms, McDonald's. So these are high quality, amazing businesses that, if we could ever get them at the right price, we would be very happy to own them. And so historically, dividend aristocrats, just given this high quality business nature, have typically traded at a slight premium to the S&P. And recently, just like small caps, we've seen a divergence in that historical trend. So from I believe it's 2018 to 2020, historically the aristocrats trade at a slight premium. Post COVID, we've seen this reverse, and now the dividend aristocrat fund is trading at a couple turn discount to the S&P 500. And this, again, just like small caps, it at least presents an intriguing spot to go look for ideas, because if these high quality companies are, trading at a discount to where they historically can, maybe there's some opportunities within that subset of companies. So outside of just the dividend aristocrats, this likely also applies for other income producing stocks. So if it's not small caps, then typically an income producing or a dividend company is where we're looking right now.
Yeah, so applying the same kind of framework here, maybe you two could both talk about how this discount in income producing stocks applies to some of the positions in our own portfolio.
Sure. So I'll just chime in on the chart. It's the Morningstar dividend portfolio. It's a provider that we use, can source ideas every now and then from it, and they chart, or at least they have what they have as their fair value for all the stocks in their portfolio versus the current price of the stock. So if they thought the fair value of a stock was $100 and it was currently trading at $80, it would have a price to fair value of roughly 0.8. So in this chart, it shows, and this is just for income producing stocks, it's showing that this portfolio of dividend producing stocks is trading at the lowest, or almost at the lowest it's been since the financial crisis, which again signals that there should be some opportunity in dividend producing stocks. And so on that, in our portfolio, the one I'll just chime in on, Lazard is an investment bank and an asset manager. They've had some headwinds over the past year or two, just on the CEO side, turnover at the management level, but they have historically had a steady and growing dividend, and there hasn't been a lot of bankruptcies over the past, call it, decade or so. But if you read in the news, there's some companies that are starting to struggle. That mainly stems from them taking out debt in 2020, 2021, the very low interest rate environment, and they are unable to refinance that debt at any reasonable level, which is causing them to restructure the company.
Great. Peter, anything to add on any of these names?
Just briefly, M&T Bank also is many of the regional banks got hit very hard last year after one of the banks in California failed, and so that's part of the reason why that is down. And in Corning, several of their markets, including the fiber optics and telecommunications, have flattened out. Long-term prospects appear very bright for all of them, but there's, like as Dominick had mentioned, each of them has some short-term headwinds.
So guys, in continuing with that line of questioning, if dividend payers and small companies look attractive right now, what are some of the businesses in our portfolio that you think look most promising in light of these areas? And where do we think the market is seriously undervaluing our holdings? Pete, why don't you go first on this one?
Sure. Qualcomm certainly is not a small cap company with the capitalization well over 100 billion, but it is one that has raised their dividend every year since they began their dividend. I believe it began in 2003. And as I mentioned, the world is going wireless, so the potential there is enormous. 5 Point Holdings switched CEOs a couple of years ago, and that CEO has done a really terrific job of reducing the cost of the business. They downsized numerous employees. I think they decreased employee count by 30-some%. And they've also focused on various land sales with the business. And so the future looks very bright for 5 Point. They had this most recent quarterly announcement. They had sold several pieces of land. One of the issues, of course, with 5 Point is that it's a land company, and so it's very lumpy, but very much connected to new housing starts. And we've underbuilt for many years, and so 5 Point, in our opinion, has a very bright future. Although it's been a unprofitable business in most of the period we've owned it, but we continue to feel that there's tremendous value to be uncovered. And Dominick wrote a really nice investment piece on that a few months ago, giving his understanding of that business. Dominick?
Yep. Well, happy to share the write-up if you're interested. So the two I'll talk about are Warrior Met Coal and BGC. Warrior Met, outstanding stock return in 2023. Obviously not as cheap as it was when we started the year, but they have a Blue Creek mine that is set to come online in a couple of years that people seem to be overlooking. And that mine is going to be one of the lowest cost producers and is going to generate substantial cash flows for the business. And in the meantime, Warrior Met's just generating tons and tons of cash. And at some point, either they're going to start buying back their stock or paying out more special dividends, which should be accretive either way to us. And then on BGC, they recently announced that their exchange, it's called FMX. We've been waiting for about a year now for it to get approved by the CFTC. They announced it, I believe, 2 days ago, that it's gotten approval. It's going to be competing against the CME, which is a $100 billion company and has had no competition for their primary products in the past decade or two. And now BGC is going to go up against them, and they've already started to take market share from them. And so the main thesis is nobody really understands how much earnings and how much cash flows this company can generate in the next couple of years. And the stock remains incredibly cheap and probably one that I'm most excited for in 2024 and beyond.
Great. Well, we've been talking for a while, and I think maybe it's time to check on some of the questions that have come in during the call. As a reminder, if you would like, you can use the chat box or the Q&A feature to submit some questions to us. I do have a question here regarding just our thoughts on whether or not NVIDIA will be splitting its stock anytime soon. Any thoughts there, guys?
I don't know, but it wouldn't shock me. I guess we're at almost $600 a share. I can't remember when they did it last time, but doesn't seem like an unreasonable thing to do at this price.
I believe the stock was about 800 last time they split it.
Yeah, they did a 4
And
for
it was
1.
a 4-for-1 split.
Yeah. Usually there's no advanced notice on stock splits. We get a notice that they are splitting, but there's nothing leading up to it. And NVIDIA, that outside of that one split, we haven't had much of a history to really go off of in terms of splits. So to be determined. Any other questions for the investment team here? Give you guys a minute. All right. Here's another question. With the stock market run up lasting nearly 15 years, which seems unsustainable, at least to me, are there circumstances where you would consider maintaining cash?
I would say our cash is as high as it's ever been in the history of our company. So we have plenty of cash reserves. One of the nice parts is cash is currently paying about 5%. And so depending on the particular needs of our client, that also can dictate how much we hold in cash. From a financial planning standpoint, very often it's advantageous to have possibly 2 or possibly 3 years of cash for an individual so that we have clear path to making distributions to them without having to worry about ups and downs in the market.
Yeah, I think when interest rates were 0 and holding cash was almost guaranteed to be a drag on performance, I would say we're probably relatively reluctant to hold cash. Given that you can get 5% now, it has certainly raised the bar as to what we're willing to invest in. If we can get a guaranteed 5% or a risky 7, it probably doesn't sound like a good opportunity. But if we could get 7 when interest rates were 0, that seemed a little more reasonable. So I would say going forward, if we can't find ideas, I'd say we're more likely to hold cash than invest in something where the return might not be as great as we want.
Yeah, and I'll chime in here as well. As new money comes into portfolios, our team has decided to take more of a phase-in approach as opposed to dropping a huge lump sum installment into the portfolio, with the thought being that we want to maintain some optionality. There's every reason to believe that this year will carry some volatility, if not only then that if we look back to 1980, I think the average intra-year decline, so the ups and downs, on average, we've had a 14% decline in each of those 30 years. So we have an election year here. There's plenty of geopolitical tension. We're coming off exceptional return year in the U.S. markets. So I think a phase-in approach that maintains some cash with the option to advance into the market if we did see a big drop is a prudent thing to do right now. Great question. I'll give it 1 more minute for questions. Please use the chat box if you have any. great questions so far, everybody. I'll ask you guys a question that I have. Can you talk a little bit about what the research team has on the agenda in the next quarter or two with any research trips planned or special coursework that you'll be exploring?
Go ahead, Dom.
Yeah, I believe in May I have a trip to Chicago. It's called the Midwest Ideas Conference. I went to a similar one last year that was in Dallas. It's a group of, I believe it's 50 to 60 on the smaller side companies. This past one was great for idea generation and to meet with different management teams. The presentation or the conference is put on by basically like an investment consultant, and a lot of the companies that come are their clients. And so you just get to, you not only get to meet a lot of investors, but also get to see a lot of companies that I probably would otherwise not find.
And I'm planning on attending the NVIDIA's GPU conference in San Jose in March. It also gives me an opportunity to visit some of the land holdings of 5 Point Holdings in Irvine, in San Francisco, and the properties that they have just north of Los Angeles as well. So we've got several things in the works here.
Great. Well, thank you to those of you who've typed in some feedback for us. We're at almost the 45-minute mark here, so we're going to wrap things up for today. Thank you very much for joining us on our first quarterly investor call for 2024. We will get this recording up on our website and on our YouTube channel. And if you have any questions, please feel free to chime in throughout the quarter, and we will be sure to address those on our next call, which will be scheduled for April. Have a great afternoon, everybody.